Hello and welcome to the Income Ave quarterly update on fixed income markets. As always, joined with Matt Taylor, our portfolio manager of fixed income portfolios. Matt, a lot of stuff going on in the world, especially the bond market, Fed, everything else. So let's maybe dig in to see, currently where we're at and where we're going.
Yeah, definitely. So yesterday there was a Fed meeting. A lot was said there, and a lot was, and more than I was expecting actually. So I was just dive right in and talk about some of the analysis from the Fed and some of the key takeaways.
What surprised you, Matt?
Um, there was just more information. So the runoff on the treasuries to slow that down to 5 billion was one thing, and just Powell's overall, he came across more dovish than hawkish, I guess, by the fact he wasn't a hawk, he defaults into being a dove. But he just expressed a lot of uncertainty at the Fed. It seems like they're as confused as some of these other as a lot of investors out there on where the economy is going, where's inflation going, and they're in a wait and see approach. So the key takeaways I found were that, because of the uncertainty, they think Fed funds is in a good place. It gives them the ability to, cut rates they need to or stay pat if they need to, depending on how the economy develops. The big one was, they increased their inflation outlook and decreased the growth outlook. That's not a good thing. So they're saying inflation could be a little hotter than expected, while growth is going to be lower than expected.
We're reading a lot, Matt, about stagflation, right? I mean, you look at the issues around stagflation. Are we looking at a scenario like that as the Fed kind of downgrades growth outlook, inflation outlook upgraded?
I think the probability is increased. If you look at the numbers they've put out, it's not saying stagflation yet. But when you put a probability to it, it's definitely higher than it was, call it 6 months ago, I think.
And the labor market, for the most part, seems to be holding in for now, right? So that's another key piece of stagflation.
Yeah, the labor market's holding in for now, and even the GDP outlook. I put, they're projecting 1.7% for GDP. Now that's not a stagflation number. You have to be a little bit lower than that, probably. But I also would say that, listening to Powell speak yesterday, I don't think there's a ton of confidence on where GDP is going either. So we have to kind of see how the data comes in and how things develop.
So as you look to what you heard yesterday, Matt, when you see the Fed, cutting rates potentially, or obviously it's going to be data dependent, but your best guess is you kind of look what we're seeing now.
Yeah, I would say summertime or even late summer. So there's gonna be three meetings I'm keying in on and how the data develops. The June meeting, I think, would be the very earliest they would cut. July is a possibility, and then September is probably the latest if they are going to cut this year. They start with the cut. And then, obviously, as data comes in, we'll have our opinions and our assessments going to change. But as of right now, I'd say the very earliest would be June, in my opinion.
And the dot plot's pretty interesting to kind of reiterate what you're just saying, right?
Yeah. So here's the dot plot. The big takeaway from this is that while the overall expectation of where the interest rates are going to be at the end of this year, so if you look at the block dots, it's still at 3.9 or 3.875% is the average dot. And I'm comparing here the March dot plot to the December dot plot. But my takeaway is how these dots have really tightened up a lot. So back in December, you had, some participants saying, around, just above three, a little bit below 3.5. But you've seen everyone shift up. You even have from one person saying no cuts to four saying no cuts. Now you have four people saying one cuts versus three. So, and then everyone's moved up. So there seems to be a much greater consensus for 2025 from the Fed on where rates are going. While the out years are still anyone's guess, it looks like. I mean, these things are all over the place. So, and I'm looking at CPI. So I have two graphs here. This is core CPI and headline CPI. So the headline number is going to be the blue graph, and the core number is going to be the orange graph. Now, the Fed always prefers to look at the core because, as you can see just from these graphs right here, it's much smoother. You don't have these wild swings up and down because of oil and food pricing. but at the end, you typically do end up around the same spot. Overall, CPI has come down significantly. We were on the core, we are over 6% in 2022. Now we're right around 3.1 on core. There's an old saying though, it's easy to go from 6 to 3. It's at 3 to 2 that's the hardest part a lot of times. So, is the Fed going to be able to get to that 2% in the near future? Well, then time will tell.
Man, why is inflation so important to the bond market? And as you're looking at things, and you know, given where inflation is, where should rates be right now, right? So I think those are two good points to dig in.
Yeah, well, inflation is important to the bond market because it's going to eat into the pricing power of future cash and future earnings. So if inflation is at 3%, if you're investing in bonds, you're going to want to make at least that 3%, preferably more, just to keep up with the pricing power of your cash and present value. So I do, typically you'll see Fed funds neutral rate between 50 and 100 basis points or a 0.5% to 1% over inflation. And then the curve can develop from there depending on where people see inflation going in the future. Typically, you'll see, a 10-year treasury about 150 basis points, maybe 200 over that. And it will dictate where bonds are pricing and what interest rate investors can obtain from bonds. So looking at the core on a month-over-month basis, because this is the Fed's favorite way to look at it, you have seen some improvement over the last couple of months, and on an annualized basis. So I always like to look at the year over year, and also looking at an annualized 3-month, 4-month, and 6-month to see the trend. Looking at the 6-month, 4-month, and 3-month, you see the trend's getting better. It went from a 3.4 to a 3.3 to a 3.2 annualized, but we're still above the year over year 3.1 rate. And that's because back in May and June of last year, those numbers were very, very low, which was, gave the market some hope. This year, we'll see how that runoff happens, but it seems to me like we're going to be sitting right around this 3 level for a little bit until we get a little more clarity on some of these other issues affecting the bond market.
Well, to your point, man, look at those May and June numbers, right? So if they come in like we've been averaging either 2 or 3 tenths, it's gonna be hard to get below 3%, until you get to late summer, early fall, right?
Exactly. And that's what I'm looking at also is that, these numbers probably should be higher than 1/10 when they come out. So I think sticking around this 3 plus or minus is probably a safe bet. And then the other thing the Fed did do, this was a big deal, I thought. They downgraded the GDP projection. So this is straight from the Fed's summary of economic projections, which they release every other meeting. As you can see, the real GDP, they expected it to be 2.1% in December. They reduced that to 1.7. They also reduced the out years to 1.8 and 1.8, which is showing uncertainty on economic growth. But they also, while reducing that, they also did increase the PCE expectation. So they were expecting core PCE to be 2.5. Now they're saying it's going to be closer to 2.8 this year, but they do expect to gradually get down to that 2% by 2027. I would say that this year is probably good estimates. I don't think the Fed really knows what's going to be happening in 26 and 27 yet. We really have to see how things digress in this economy and look to see where the information tells us we're going.
Yeah, the interesting thing there is the labor market, right? I mean, you have if there's worries about stagflation, the Fed's not worried about it from the employment side, right? And it's interesting given all the noise with layoffs and other government reductions that Fed doesn't seem to be too worried about the labor side, and so far it hasn't shown in the monthly data or weekly data within the labor market. So interesting to see the labor market hanging in for the most part.
Yeah, I agree. Because with the Fed's dual mandate, it is price stability and full employment. And the Fed is projecting full employment, even though we're going to tick up to a 4.4 they're expecting. Historically, that is full employment. So I'm really watching the employment numbers to any sign of any Fed action, going forward. Because if you do see that tick up significantly, let's say high fours, you could see the Fed really come in at that point. The other thing they mentioned was the balance sheet and how they're going to reduce the runoff of Treasury securities. So in the current environment, they had a cap of $25 billion a month of running off the Treasury securities and 35 billion a month of mortgage-backed securities. Now, the mortgage-backed security runoff has not been 35 billion for years now, at least for a while. Uh, so they feel no need to reduce that cap, but they did reduce the Treasury cap. And you can see, you know, quantitative easing first started, and then in 2020, after COVID, we really escalated and spiked up significantly. So right now, the balance sheet sits around 6.8 billion, and that comprises of treasuries, mortgage backs, and there's also a lot of other small things in there like loans, gold, currencies, things like that. I like to look at this chart a little bit differently, and I'm going to break it down by asset class. The green line is the treasury holdings, while the orange line is going to be the MBS or mortgage-backed securities holdings. And that little blue line on the bottom is going to be unamortized premium on these mortgage-backed securities. So that's the additional amount the Fed had to pay for some of the mortgage-backed securities to buy them back in the 2010 through 2020 and even 2020 through 22. You can expect the green line runoff to just flatten out at 5 billion a month. That's only going to be 60 billion a year, so that will probably flatten out pretty well. While the MBS runoff has been averaging around 200 million a year, give or take a couple tens of billions. I'm sorry. So overall, with the current balance sheet at 6.8, you can probably expect it to be down to around 6.5-ish by the end of this year. And then, once we get to like 2027, it might be below 6 billion at that point. Now, during the press conference, Powell did signal that they don't expect to increase the cap on treasuries anytime soon. There was speculation that this would just be a temporary cap. But my interpretation of what he said in the press conference is this is the new cap and expected to stay here for a while.
Man, talk about the balance sheet a little bit more. Why is this, directionally, why is the Fed kind of starting to pause a little bit now? Is it the uncertainty? Do they feel like they've done enough? Are they just trying to keep liquidity in the system? What do you think's kind of behind slowing the runoff now?
Yeah, this has a lot to do with the different cash reserves within the financial system. And I think with some of the uncertainty around the debt ceiling and the continuing resolution that's put in place until September and other issues, you could see if there was a government shutdown come September or something like that, you could see a crunch in the cash reserves. So the Fed's conscious of that, and they're being very cautious on their approach. And the way they look at it is, their end number on the balance sheet's probably, below 6 at some point, but they don't mind taking their time getting there. And they rather err on the side of a caution and make sure that the cash reserves are ample. We can all remember back in 2018 when they kind of withdrew liquidity faster than the market was wanting or expected, and we saw a huge rally in or sell off in the treasury market and in the equity market to go along with that because of the movement in yield. So the Fed is just trying to avoid that and to make sure there's still ample liquidity in the system. So turning to the current 10-year treasury, I'm looking back here for a couple of years here, and I drew some lines on this chart. This is where I'm looking at for technical levels and where I'm thinking, we're going to be trading from a range perspective. So the first line where we're at currently is right around 4.2. I think we're a little bit lower right now today, but that's kind of right in the middle of where we've been. So the current range that I feel like we're in is be a 450 to a 410. You can see we bounced off that 410 level twice. If we break that 410 level, I think it's almost inevitable we hit a 4% just from psychological issues and people where the market goes a lot of times. Then once again, if we do break that 4%, I'm looking at the previous low, which is right around 363. Um, Oftentimes you'll get a trade, in the middle of that. But I do see the lowest I would expect the 10-year yields to go in the near term at least is a 3.3%. And that's just going to be historical lows from a couple of years ago.
So Matt, walk me through a scenario, maybe how do we get to 3.3 or below? What might happen? And on the other side, what happens if, what scenario would you envision getting above 475?
Yeah, so in order to get to 3.3 or below, you would have to see GDP slow and stall out significantly, so lower than what the Fed is saying, and also unemployment to start to spike. Now, just from yesterday, you've seen Treasury spreads move down about 15 basis points. I think a lot of that has to do with the runoff announcement and things like that, and also downgrading the GDP. So you could see yields go significantly lower if we do enter a recession. Um, 4% could happen just from GDP growth slowing or unemployment slowing. But to get to that 3.3, I would say you probably need a recession to get something down there.
And
Uh,
then the other side, how do you get above 475?
475 is going to be inflation. If inflation starts to really tick higher, um, or you'll also see a large amount of issuance potentially on the back end of this year. That could cause it just because supply's coming out. You've had announcements from numerous central banks. Looking at Europe even, they're issuing a lot more debt over there. That's going to affect our markets. While the new Treasury Secretary Bessent has said the next couple quarters he's not going to be increasing the note sizes on auctions. If you look at the math of what the administration wants to do as far as spending and tax cuts and everything else, there's going to be a big deficit they need to fill next year. So they're going to have to issue more debt for that reason too. That mixed with inflation, you could definitely push yields higher. So there's lots of factors affecting a lot of things, and it's a lot of uncertainty, and that's what I'm looking at for as far as yields and some of the levels that will tell me which way we're going to.
And your base case, I guess, kind of summing it together, you kind of feel like we're in this range until some of those data points move higher or lower to really justify moving yields dramatically one way or the other.
Yeah, I would say base case is range bound right now. Obviously, as data comes in, we can definitely break some of these levels. But even right now, even at a 420 yield, we're kind of in the middle, that 410, 450, it's right in that range. But I'm watching those levels very like a hawk and trying to decide, which way this market's going. So just talking about macro factors that do affect fixed income, the big two are inflation and economic growth. Um, just for reasons we discussed already. If inflation is high, people are going to want a higher return on their bonds. If economic growth is slow, investors will expect the Fed to cut rates potentially to juice economic growth. Bond issuance, like we discussed, the increase in bond issuance, just basic supply demand imbalances. You increase supply while demand stays the same. You should see a higher yields. Central bank actions. Now, this isn't just cutting rates, it's also intervention. You've had yield curve control over in Japan for a number of years. That's now done, and they're actually raising rates. That does affect our market also. Um, and then whatever the people Bank of China does, that's going to affect our markets too. Movements in currency. This has to do with foreign buyers coming in and buying our debt and how their hedging abilities. And while it's not as big as an impact, it does impact some of the factors affecting fixed income. Geopolitical risk, any kind of uncertainty in this world, we definitely get a flight to quality a lot of times. So some stuff that happens over in the Middle East or some of the wars going on that does affect geopolitics, and you do see a flight to quality. Credit spreads overall, this is just looking at the amount of additional yield investors want for corporate bonds or any kind of credit bond over the treasury, and then individual sector risk. So, uh, if you're buying banks versus staples versus healthcare, there's obviously different risks within those sectors.
Now let's talk about, maybe credit risk and the spreads
Yeah,
overall and kind of tie
yeah,
it back together with our strategy.
definitely, definitely. So, um, the big factors affecting individual bonds are the credit risk, liquidity risk, and duration. So credit risk is just the risk that the issuer may default on the interest payment or on the principal payment. And looking at credit risk, um, here's a graph right here. This is credit default swaps. This is looking at the IG index for credit default swaps on a 5-year basis. Now, while the numbers don't aren't exactly the same as bonds, the trend is the same. So um, you can see back in 2001, credit spreads were getting tight. Then when yields started to move out, you actually saw credit spreads move out too. So we hit 110 basis points near the top. And this is just for the IG bonds. And then you can see over the next couple of years, we have gradually come down and we're at historic lows. We have bounced off the historic number back at the end of February, just with some of the issues going on in these markets now, but we're at historic lows on that aspect. And looking back, even the years before COVID, you can see that 100 basis points wasn't that abnormal. I would say the average was between 80 and 90 on credit default swaps. And that means corporate spreads is probably 20 to 30 wider from there. So historically, we're at low corporate spreads. Same thing's true for high yield. These numbers are a little exaggerated because this is looking at the whole high yield universe. So you'll be looking at some of the D's and C rated stuff, which is definitely not an area we're involved in, but the trend is exactly the same.
Matt, we're reading a lot about defaults, right? A lot of bankruptcies, retail, restaurants, you name it. I mean, how much of that worries you? And, typically, what do you see by the time, a company files for bankruptcy from, a loss of principal standpoint in the bond market?
Yeah, typically when a company files from bankruptcy, it's pretty already well known there's issues with that company, so it's trading at distress levels already. Um, the way I've approached it, and looking at portfolios is, you know, the defaults that have occurred are very sector specific. They're going to be consumer discretionary, some places in the restaurant industry, retail, stores. I've just tried to avoid a lot of those sectors for the most part, unless you can look at the analysis and be very comfortable with the credit. And we do own a couple names in those sectors, but once again, we've done our credit analysis. We look at the cash flow generation or the asset coverage, and we can really get behind things like that we do our homework on. But for the most part, uh, like I said before, before a company actually defaults, you'll see the price decline significantly as the market's already sniffed it out and knows what's going on. So going back to the credit spreads, this is a chart here of where A-rated bonds and triple B-rated bonds are relative to the Treasury curve. Um, the red line, so this is the Treasury. The green line is the Treasury. The blue line is the A-rated, and the red line is the triple B-rated. On the bottom, this just shows you the additional basis points you're picking up on each maturity over the Treasury. Once again, the blue line is the A-rated, and the red line is the triple B rated. There's not you're picking up an additional about 30 basis points on average between A and B. But once again, you're looking at mid yield. So you can't just, sometimes I can buy a triple B rated bond at the same rate I buy an A rated bond, because there could be some issues or bid ask spreads or things like that that have to do with it. So what we've been doing in the portfolio is definitely, when new money comes in, we're buying higher quality stuff right now. We don't think we're getting compensated enough sometimes to take the additional risk to go down in a lower tier. If we are getting compensated enough, we have no problem if we're comfortable with credits going down a little bit lower on the tier. But right now, our preference would be to upgrade credit quality in the portfolios.
Well, and talk about that a little bit, Matt, because the reality is, let's say we play out that scenario where we go into a recession, right, and yields fall, right? The trouble with being in lower credit quality, right? Credit spreads could widen, interest rates go down, and you don't make money as you would expect because credit spreads widen. Where if you upgrade quality, you know, you could protect yourself in that scenario if you have a
Yeah,
type of
no,
recession.
exactly. So the idea of upgrading credit quality is that if we do enter into a slowdown in the economy or even a recession, while theoretically the financials of a company are still sound and not stressed by any means, the market's going to react to it, and you'll see corporate spreads move out back to levels that we saw, back in 2022. So while let's say the U.S. Treasury bonds go in 50 basis points, you could see a corporate bond go from that 60 to the 110. So you're not benefiting from that movement uh, because the corporate spreads have gone out. Now, if by increasing credit quality and buying higher rated companies, you shouldn't go from that 60 to that 110. You'll probably go from a 60 to a 70 or a 60 to an 80 because of the higher credit quality. And that way you actually do pick up some of the additional dollars that from the duration movement and the interest rate movement on the treasury. So
Yeah, but let's maybe skip ahead to the kind of strategy and what's in place between what you're working on, what you're doing, and what we're looking ahead to.
yeah, so as far as strategy goes, first thing you look at and you want to start with always is the current treasury curve. Though right now you see, the treasury curve is paying you about 4.25% in the first, 6 months to a year, then it dips down significantly. And this is because what this tells me is the market is expecting Fed to cut rates, to 4%, which they've signaled. Um, and they could see some economic issues going forward. But then on the back end, they do think that things will normalize and inflation will come in at 2. So in this scenario, my preference from a strategy standpoint is to do more of an intermediate barbell approach. So I don't mind sitting on the short end of the curve, getting paid 4% for a portion of the portfolio. When the bonds that we're looking at and some of the stuff we're buying, we're getting closer to 5. And the Fed's already signaled they're not going to be cutting rates anytime soon. So it's a good place to kind of hide out and wait to see how things progress. And then you can redeploy those assets when they mature. But then I want to take the other part of the portfolio and look right in this, call it 5 to 10 year range and selectively pick out relative value credits that make a lot of sense. And that's more just to lock in some yield for a while too. Um, and the benefit of this also is that if the Fed does cut rates, the Fed controls the front end of the curve only. They don't control the back end of the curve. But if the Fed is cutting rates over the next couple of years, and I have a 5 year bond, well, in 2 years is now a 3 year bond, and where the Fed funds rate is will affect that, and you could get some appreciation on that bond also from rolling down from a 5 to a 3 year portion. But then, while we do both those barbell strategies with the short end and the intermediate, we are always looking for relative value opportunities and sprinkling in bonds, all the way out to 25 years, or even a little bit shorter when we see opportunities when they present themselves. And just kind of going over some of the strategies that we do have. We do have our core fixed income strategy, and this is where a lot of our assets are in. And this strategy looks at both investment grade and high yield bonds. So when we look at the high yield bonds, like we talked earlier, we focus on what I have to call high grade, high yield, doing our research, looking at companies that have strong cash flows. Just because a company's is a high yield rated company does not mean it's a riskier company all the time in our minds. Some companies can operate their business at a higher leverage, and they do that for a reason. So they prefer to have that high yield rating. But when looking at cash flow analysis and coverage analysis, we can see that these bonds are pretty good investments for the most part, and we're very comfortable, So in that, so looking at high yield, we're mostly focused on the double B space, maybe dipping into the single B here and there. But for the most part, it's high grade, high yield is how I like to look at it. As far as liquidity goes, it's gonna be mixed. A lot of the investment grade bonds are pretty highly liquid. Some of these high yield bonds, or even some of the investment grade bonds, you might buy stuff that is a smaller issue. So it's not going to be as liquid, but overall liquidity is fine. We can usually turn this into cash with pretty minimal cost. And we target an intermediate duration here. So when I say target intermediate duration, I'm thinking, an average duration between 3 and 5, probably 4 plus or take. We can adjust that as we see the market change, but we do have the ability to invest throughout the yield curve. So we can buy 1 month paper all the way to 50-year paper if we see fit. And we were definitely looking to, look to see, position our bonds, along the curve where we see the best value at the time. Another strategy we do offer is to be an investment grade fixed income strategy. Now, this is for investors that might have some parameters that they can only buy investment grade, or just investors that just only want to have investment grades in their bonds, investment grade bonds in their portfolio. So this is very high quality bonds. Liquidity is typically really good on these. We typically target again an intermediate duration, but we can do customized duration here. So if you're trying to offset some kind of liability in the future, we can customize it to that and do a longer duration or a shorter duration. And then our municipal strategy. This is a great strategy for any high taxpayer out there. We typically focus on A-rated and better credits. Majority is probably AA and AAA. Liquidity is average, could be poor sometimes. So the longer the duration, the lower liquidity is a lot of times in the muni market. And once again, we're trying to focus on the intermediate duration, but we can also do customized to offset some liabilities or just whatever the client's looking for. Now, if you're in the highest tax bracket, the municipal bonds on a risk reward on an after-tax yield is superior in my mind to corporate bonds or even treasuries, because you're getting very, very high quality credits, usually AA, AAA, at an after-tax yield that's significantly higher than you can get on treasury paper. And then popular lately have been our short duration strategies. Government only, this just looks at treasuries and government agencies. Very good liquidity. You're typically looking at pennies on a bid-ask spread here. And all maturities are going to be inside 13 months. This is ideal for people that just want to generate some income while they're trying to figure out what to do with their cash. They don't know what they're going to have unexpected outlays coming soon. This is the best strategy for someone like that. The taxable strategy, is going to offer a little more yield. You can probably pick up about 50 basis points over the treasuries on average. Liquidity is still pretty good. We do have some treasuries and agencies in this strategy for liquidity purposes. And then the tax-free strategy, once again, for the high income earners, this is probably the best one because you're picking up superior after-tax yield in the current environment versus everything else. And we're looking at AA and higher. We do have some treasuries in there just because if there's liquidity need, it's easier to sell the treasuries than the municipals. But on average, you're probably getting, an after-tax yield closer to 5% for AA, AAA bonds versus a government bond that you're getting around probably a 4.20 yield on average. So
As you tie everything together, Matt, I mean, it's obviously a uncertain picture, right? I mean, you look at everything we're going through, but I think for the standpoint of looking at strategy near term, maybe you want to summarize kind of overall strategy near term and then, outlook as we close this up.
yeah, the overall strategy near term is going to be, upgrading credit quality, and protecting principal while generating income. So, I mean, right now we're definitely in uncertain times. Whenever everything times get uncertain, I kind of default to safety. So making sure that we're protecting our principal while generating, good income for our clients is the key. As far as positioning on the core strategy, like I said, the intermediate barbell approach, where we're having some bonds coming due in the next, call it 6 months to 18 months to take advantage of any possible issues going on and any dislocations in the market. So we have bonds coming due to take advantage of that, while also locking in a little bit longer term rates with the other portion of the portfolio. We think straddling that's probably the best thing right now going forward, especially with trying to figure out what's going on and what's happening with these markets. So,
All right, with that, Randall, thank you for tuning in, and I'm sure when we record a quarter from now, it'll be a lot different picture. We'll see.
thank you.